Like any industry, investing has its own language, and one term people often use is investment portfolio, which refers to all of your invested assets. Building an investment portfolio might seem intimidating, but there are steps you can take to make the process painless. No matter how engaged you want to be with your investment portfolio, there's an option for you. But what exactly is a portfolio, and is it something you should consider? In this episode, we've provided a summary of what an investment portfolio is, how it works, types of portfolios, and how to build an investment portfolio. But before we go too far, don't forget to hit that subscribe button so you don't miss the next videos on the asset types to include in your portfolio. What is a portfolio? An investment portfolio is a collection of assets and can include investments like stocks, bonds, mutual funds, and exchange-traded funds. An investment portfolio is more of a concept than a physical space, especially in the age of digital investing, but it can be helpful to think of all your assets under one roof. How does an investment portfolio work? An investment portfolio is a basket of assets that can hold stocks, bonds, cash, and more. Investors aim for a return by mixing these securities in a way that reflects their risk tolerance and financial goals. The following two terms are associated with investment portfolio. Asset allocation. Asset allocation describes the balance of stocks, bonds, and cash in your portfolio. Depending on your investment strategy, you'll set the percentage of each type of asset in your portfolio in order to reach your goals. As markets rise and fall over time, your asset allocation tends to get out of whack. Say shares of Tesla surge, the percentage of your portfolio allocated to stocks will probably surge higher too. Diversification. It is a bad investing idea to have all of your eggs in one basket, especially when it comes to building an investment portfolio. That's why your portfolio requires diversification. A healthy mix of different investment assets, stocks, bonds, and cash, and different types of stocks and bonds keeps your portfolio growing under different market scenarios. In a bull market, when stock prices are rising for example, bond yields are generally declining. Even as you're potentially losing money in bonds, a well-balanced equity component of your portfolio should make up the difference. In down markets or during a crisis, investors may push up the value of bonds as stocks are heading lower. One of the easiest ways to achieve portfolio diversification is by investing in index funds and ETFs. When you own low-cost funds in your portfolio, you get exposure to hundreds or thousands of different stocks and bonds in a single security. You can construct a well-diversified portfolio yourself with as little as 2 or 3 funds, or you can let the experts do it with a target date fund. Financial advisors and robo-advisors can also manage portfolio diversification for you, though this will come at a slightly higher premium than if you did it yourself. So, what types of portfolios do we have? Portfolios come in various types according to their strategies for investment. There are 5 portfolio types as follows. Growth portfolio. From the name itself, a growth portfolio's aim is to promote growth by taking greater risk, including investing in growing industries. Portfolios focused on growth investments typically offer both higher potential rewards and concurrent higher potential risk. Growth investing often involves investments in younger companies that have more potential for growth as compared to larger, well-established firms. Income portfolio. Generally speaking, an income portfolio is more focused on securing regular income from investments as opposed to focusing on potential capital gains. An example is buying stocks based on the stock's dividend rather than on a history of share price appreciation. Value portfolio. For value portfolios, an investor takes advantage of buying cheap assets by valuation. They're especially useful during difficult economic times when many businesses and investments struggle to survive and stay afloat. Investors then search for companies with profit potential but that are currently priced below what analysis deems their fair market value to be. In short, value investing focuses on finding bargains in the market. Defensive portfolio. This type is also called a conservative portfolio or a capital preservation portfolio. Defensive investment portfolios keep risk low to preserve your investment dollars. They achieve this by owning bond funds and income-producing dividend stocks. Defensive portfolios are widely used by older investors who are nearing retirement or already retired and don't want to risk losing their capital. Balanced portfolio. A balanced portfolio is one that holds a variety of different kinds of investments. For example, some stocks, bonds, real estate, and gold perhaps. The idea is that when one of the investments goes down in value, another one will go up. Investment portfolio versus savings account. When you use the word saving and investing, people, really over 90% of people, think it's exactly the same thing. While the two efforts share a few similarities, saving and investing are different in most respects, and that begins with the type of assets in each account. When you think of saving, think of bank products such as savings account, money markets and CDs or certificates of deposit. And when you think of investing, think of stocks, ETFs, bonds and mutual funds. How to build a portfolio. To create a good investment portfolio, an investor should take note of the following steps. 1. Decide how much help you want. If building an investment portfolio from scratch sounds like a chore, you can still invest and manage your money without taking the DIY route. Robo-advisors are an inexpensive alternative. They take your risk tolerance and overall goals into account and build and manage an investment portfolio for you. If you want more than just investment management, an online financial planning service or a financial advisor can help you build your portfolio and map out a comprehensive financial plan. 2. Choose an account that works towards your goals. To build an investment portfolio, you'll need an investment account. There are several different types of investment accounts. Some, like IRAs, are meant for retirement and offer tax advantages for the money you invest. Regular taxable brokerage accounts are better for non-retirement goals, like a down payment on a house. If you need money you're planning on investing within the next 5 years, it may be better suited to a high-yield savings account. Consider what exactly it is you're investing for before you choose an account. You can open an IRA or brokerage account at an online broker. 3. Choose your investments based on your risk tolerance. After opening an investment account, you'll need to fill your portfolio with the actual assets you want to invest in. Common types of investments include stocks, bonds, and mutual funds. While you may think of other things as investments, your home, cars, or art, for example, those typically aren't considered part of an investment portfolio. 4. Determine the best asset allocation for you. So, you know you want to invest in mostly funds, some bonds, and a few individual stocks, but how do you decide exactly how much of each asset class you need? The way you split up your portfolio among different types of assets is called your asset allocation, and it's highly dependent on your risk tolerance. You may have heard of recommendations about how much money to allocate to stocks versus bonds. Commonly cited rules of thumb suggest subtracting your age from 100 or 110 to determine what portion of your portfolio should be dedicated to stock investments. For example, if you're 30, these rules suggest 70 to 80% of your portfolio allocated to stocks, leaving 20 to 30% of your portfolio for bond investments. In your 60s, that mix shifts to 50 to 60% allocated to stocks and 40 to 50% allocated to bonds. When you're creating a portfolio from scratch, it can be helpful to look at model portfolios to give you a framework for how you might want to allocate your own assets. 5. Rebalance your investment portfolio as needed. Over time, your chosen asset allocation may get out of whack. If one of your stock rises in value, it may disrupt the proportions of your portfolio. Rebalancing is how you restore your investment portfolio to its original makeup. If you're using a robo-advisor, you probably won't need to worry about this, as the advisor will likely automatically rebalance your portfolio as needed. Some investments can even rebalance themselves, such as target date funds, a type of mutual fund that automatically rebalances over time. Do I need an investment portfolio? If you're looking to dive into the investing world, you certainly need an investment portfolio. By creating a diversified investment portfolio, which is to spread capital across more than just one investment category, investors can reap benefits. Diversification into multiple asset classes will help to protect an investor's capital in the event that one segment of the financial markets doesn't perform well. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.